The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners out there had a fun and exciting and or relaxing, I suppose, weekend. My name is Mark Longo, and I will be your host for this exciting journey through the world of options, and I am joined, as always, by good old Don Schlesinger from the Volatility Exchange. Don, how are you doing this lovely, or perhaps not as lovely, in your neck of the woods Monday morning?
Doing fine, Mark. We have a rainy day here in New York, but you told me earlier that it was a little brighter in Chicago, so since we always get your weather, I'm looking forward to tomorrow being a somewhat sunnier day. I also am nicely rested from my week off. I think the listeners had the pleasure of hearing you and our CEO of the Volatility Exchange, Bob Krause, last week at the Option Industry Council conference down in Savannah, Georgia. I hope the listeners enjoyed the show. I know that I did, and once again, it afforded me a week off.
Yeah, you missed us down in good old Savannah. It was fun, but we missed your melodious tones on the show, Don. It wasn't the same without you.
Well, thank you.
Yeah. And, of course, you didn't miss much in the actual show. I mean, we were just in a room for 3 days, at least I was, doing radio hits for 3 days. Didn't see much of Savannah proper, let me just put it that way. So we didn't have a scenic space like we did down in Boca, right by the court side.
Yeah, that was memorable.
You know, it wasn't as nice from an acoustic perspective, the Boca court side, but on the flip side, from a scenery and a weather perspective, it was hard to beat.
That's for sure.
All right. And with that, we're going to roll right into the old Volatility Review.
It's time for the Volatility Review.
And welcome to the Volatility Review. As the name implies, this is where we review the activity and the action that's been going on in the world of volatility for the past week. And of course, on this program, we cover the broad scope of volatility, including all of the various products, both implied and realized, which is, of course, Don's favorite. So, Don, what's been lighting up the tape over in the world of Euro Vol this past week?
Well, we had a couple of interesting developments. We had a couple of weeks ago the settlement of the May 1-month vol contract. And unlike the previous two that were in the single digits, this one, as listeners may recall, ended in quite a volatile period, and that settlement was all the way up at 12.77, which was more than 50% higher than the previous two settlements for the April and for the March contract. Now we have two contracts going simultaneously. We have the June, what we refer to as the 1-vol, the 1-month volatility contract that had 19 days in its realized volatility calculation period, and we're about halfway through it. And we have simultaneously the June 3-vol, which is the 3-month period that expires, of course, at the same time as the June 1-vol, but there we've had the clock running for 54 days and 9 to go. So it's interesting to watch the two of them side by side, take a look at the prices that each is trading at individually, but also kind of look for the potential for any kind of arbitrage, since the number of days left to expiration is identical for the two contracts. And so we basically look at the fact that the June 1 vol has 9 days to go, same thing for the June 3 vol, and therefore those 9 days will be adding exactly the same calculations and daily volatilities to the formula for the settlement. So traders might be nimble and alert for any potential arbitrage possibilities between the two contracts as they kind of figure out what the effect of future volatility will be on the remaining portion that is, of course, unknown at this time.
That'll be interesting to see if you do get some ARB activity going back and forth between the two contracts. That'll be a fun stat to watch.
And again, listeners can follow this in the Volex series portion under the data button on the menu on the website, where we list not only the current vol contract price, but also that P-vol for partial volatility, the part that has been calculated already by the formula, and then what we're referring to as inferred volatility, the I-vol, the part that we would have to have in the remaining time to expiration to justify the price at which the contract has settled or is trading at the moment. So they can follow along and try to see whether those inferred vols are lining up, sort of predicting the same volatilities. They should be awfully close because they're really predicting the same period of time that remains to the expiration.
Next thing you know, the high freak guys will be lighting up your tape, arbing back and forth between the two contracts.
Nothing would give me more pleasure.
There we go. Volex, the home of high freak in the volatility world. All right, Don.
Coming to an exchange near you soon.
I think a lot of exchanges in the derivative space are vying for that volume these days. It'll be interesting to see if Volex can pull it off. Okay, Don, that's going to close out the old volatility review. And with that, we're going to roll right into our strategy session.
The strategy session.
And welcome to the strategy session. This is where Don and I sit down and parse and explore and break down some particular strategy or trading technique and analyze it from a volatility perspective and discuss different ways to handle it and manage it and implement it in your daily trading. And of course, we at this show here get a lot of feedback about different aspects of managing volatility in your positions. And of course, when you're talking about volatility and volatility trading, effective management is really what separates the men from the boys. Anyone can come in and buy a long vol position and let it go to expiration. There's not much skill required in that style of trading. What really separates the pros from the beginners and the people who maximize their profits are the ones who are able to manage their volatility and their overall positions effectively, and using it without, on the one hand, being able to manage it enough to maximize your profits without perhaps over managing or over tweaking and over adjusting, which can just lead to needless commissions and perhaps even reduce your overall returns. Now, we've talked in the past about delta neutral trading and how that needs constant adjustment and constant management and the various ways to maximize your delta neutral positions. But there are other spreads and other ways of trading and other positions that are very popular that we receive feedback on that also pose unique challenges from a risk management and from a volatility perspective. And I think one of the most popular and probably also one of the most confusing, judging from the years of questions we received on this one at the old Options Insider, is of course the old 1-by-2 ratio spread. It's a very popular technique. If you're not familiar with it, it's simply usually a long 1-by-2 is when you'll buy and at the money, or maybe near in the money or near out of the money call, and then sell two of a farther out of the money calls. Usually it's done on a ratio to either negate the cost of the first contract, so you have a net zero outlay spread, or you want to reduce the overall outlay of the position, or you really see an opportunity to maximize the discrepancy between the volatility levels on the two different strikes, and that's where I think a lot of the higher end traders set up their positions. But of course, managing these spreads is a difficult beast, because on the one hand you have the long vol, which of course means you want a lot of quick, rapid movements, and you want a lot of bouncing around and maybe moves to the downside to jack up that volatility, especially if you're delta neutral in that position. Whereas on the flip side, you also want the position to rally to your shorts and then sit there until expiration to maximize the effectiveness of your position. And of course, those are two contrasting positions and two contrasting hopes, and that usually confuses a lot of our listeners and a lot of our readers about which way they should be leaning and how they should best manage these 1x2s. And I know, Don, you have a lot of thoughts on this subject, so I will toss it over to you.
When I was on the trading desk, of course, I did a lot of time premium selling, and that involved straddles and strangles to the short side. And
selling premium? I don't believe it, sir.
Yeah, I was known to do that every once in a while, just for the heck of it. But also every once in a while, just for a little bit of variety, and when I thought there was the occasion for things setting up well, we would do these ratio spreads, and in the manner that you described, because of course you can do back spreads and do them in the reverse way, but I would usually, if it was a call spread, be long the lowest strike near at the money, and then sell 2 or some ratio above at a higher strike. And of course you can do it with puts as well. And a quick comment before we go further, and that is that with the advent of the skew after October of 1987, these things actually set up or present themselves in slightly different fashion, making the put spreads a little bit more attractive from a pricing point of view. And that's simply because as we go to the lower strikes, the out-of-the-money puts, listeners know that the implied volatilities increase on the equity skew. So buying an at-the-money and selling perhaps 2 below-the-market out-of-the-money puts allows you to sell at the higher implied volatility. Unfortunately, when you reverse that and you do it on the call side, you lose that benefit, because as the skew continues to kind of go from left to right in a descending fashion, as the strikes get higher and higher, the implieds usually get lower and lower. So if you buy an at-the-money call and you sell 2 out-of-the-money calls, you're probably selling those calls at lower implieds than what you paid for the long portion. That's simply the nature of the beast. But the part that I wanted to comment a little bit about was what you started to describe, and that is, after you put on such a position, you kind of are rooting for something. You want to bring this thing home, you want to park it in the right place, and that becomes a really challenging spread to manage if any of our listeners have tried. And that's simply because of this dual nature of how volatility, both implied and realized or actual, operates on the spread. Suppose you're starting at the money. Supposing you buy the at-the-money strike, let's call it 100, and you sell 2 out-of-the-money strikes. It could be the 90 if you're doing it with puts, or the 110 if you're doing it with calls, or a different width of strike. Obviously, you make the most money at expiration if you wind up right at the strike price. If you park the underlying exactly at where the shorts are, so that the long makes as much money as possible and the shorts go out at 0, and you keep the entire width of the spread, particularly if the price is set up so that you put it on for no debit or even a slight credit. You didn't really pay anything up front to establish the position. Well, the problem lies in just how quickly you may or may not get to the strike of the sold options.
It really works out as planned.
If this is a 1-month position, and I tell you that we're going to go up a half a point a day, and there are 21 trading days, well, you'll be delighted to inch closer to the 10-point width of the strike and wind up at your destination gradually. But if I tell you that tomorrow the underlying goes up 10, well, then you're terribly uncomfortable. So we've got the ambivalent nature of the sensitivity to an increase in volatility, because if you move too fast and you kind of get where you want to be going, but in too short a period of time, that actually has an adverse effect, and it manifests itself from what would then be a negative vega, which is to say that if implied volatility increased, you would actually suffer from the two shorts with respect to the one long. So whether you do it to the downside with puts or to the upside with calls, the challenge is to be able to manage that sensitivity not only to the actual movement, which is how quickly the underlying is moving and what the realized volatility is, but any change in implied volatility, because you might start out rooting for an increase in implied volatility to get the underlying going in the direction that you want, but you might very quickly switch hats and now be rooting for things to calm down a little bit and for implied volatility to abate for a little while, because all of a sudden you look at your screens and your analytics and you find that if implied volatility goes up, you're actually hurt by that because you got too close to the short too quickly. So it's an interesting position. It can be a profitable one where you don't have any debit or any monetary outlay at the outset, but it's a sensitive one to manage and one that presents these challenges that we've discussed.
You know, I often counsel new traders to be cautious when using the ratio because it is so attractive when they start discovering, oh, you know, I could do these spreads for little or no cost. I can do 2. I can do 1/3. I can do 1/4. I can collect. I can make this a credit spread instead of a debit spread. And that sort of temptation tends to lure you to the dark side, shall we say.
Well, you know the old saying, if it looks too good to be true, you better be careful, huh?
Exactly. And then you end up with people putting on 1/5s and all these other ratios just to collect absurd credits.
Right.
And then it blows through the top side strike or blows through the short strike, and then they're scrambling for what to do with their risk management. You know, or even, like I said, even if it's bounding around within that range for a while, they're not using effective management with it in those scenarios as well. Of course, I always have a mixed opinion of ratio spreads. On the one hand, I think they're great and fantastic. On the other hand, I always harken back to my days in the SPX pit when we'd get the most absurd ratio requests to come in for quotes of, you know, 1/3, 5, 1.5 across 6 different months that some OTC upstairs guy had priced out for a week before calling down to the floor to try to pick us off with. And they always wanted to come in right in the middle of the market, right where you want it to be as well. And It was just the essence of pick-off paper, and it was always on some absurd ratio that never made any sense. And I was like, really? He needs it 7.5 by 2 by 3 by 1.3? I mean, really, is that what he needs? That's my memories of the ratios. And, of course, the other aspect, the other side of that coin when we're talking about management and the difficulties of having, I suppose you could say, dual incentives or mixed sentiments, however you want to call it, about these types of spreads. You obviously have that in the ratio spread where you have the long vol versus the short decay position, but you also have that to an even greater extreme when we're talking calendars, you know, and these usually are when you're long front month, short second month, third month, however you want to structure it, or vice versa when you're long the calendar and you're long the far month and you're long the vega, and then you're short the near month and you're hoping for that underlying to stay rooted to that short strike so you can collect all of your maximum decay. But on the flip side, if you do stay rooted there, you're not looking too good from a vega perspective. And so once again, you have these dueling sentiments, these dueling incentives for your positions.
I used to try to do the calendar spreads because, as you mentioned, when you do a long calendar or time spread or horizontal spread, as they're sometimes referred to, and let's say you do it right at the money, when you draw the risk profile, when you draw the graph, you don't get the straight line sort of a V or an upside down V of a straddle, but you get something that looks similar, and they're curved. And the reason that they're curved is that you don't have simultaneous expirations with the two legs or the two option positions as you do with a straddle. And so when one expires near term and the other farther out, the other still has some theoretical curvature to it, even as the near term is expiring. But that point aside, looking at a long calendar spread where you buy the deferred month and sell the near term, and you draw that risk profile, it can look very similar to a short straddle. It's got a point at the top, which is the actual strike that you've selected. Let's say it's at the money, and then it sort of curves down to each side to your break-even points that are somewhat above and below. The part that's strange here, and that again is how do you root for it type of thing, is what you mentioned. When you're short a straddle, you not only don't want much movement in the underlying, but you're perfectly happy to have the implied volatility where you're marking to market each night drop, because that helps the position as well. But with the calendar spread, there is the contradictory concept that makes it very hard to know what you're rooting for, because on the one hand, from an actual volatility point of view, which is to say the movement of the underlying, if you do an at the money, you'd be perfectly happy to have the underlying do nothing whatsoever, to just stagnate, not move at all, and collect, because the decay for the near-term option is swifter, is faster than the decay of the deferred month. But at the same time that you're rooting for no movement whatsoever, you realize that vega, which is the effect of implied volatility on the price of the options, is actually positive for a calendar spread, which is to say, if volatility on each leg goes up by the same amount, it affects the deferred contract more than it does the near-term one. In other words, if implied volatility on both options, long and short, goes up by the same number of percentage points, the spread actually profits. You make money. So there you are in this ambivalent type of situation where what I just said would have you rooting for implied volatility to increase, but how is that going to happen if the underlying is stagnating, not moving at all, just sitting there, almost surely making implied volatility decrease? So it's very, very hard to get the two things to work in your favor at the same time, and in some manners of speaking, that's the most challenging part of making money with a calendar spread, because it does involve movement, it does involve volatility, and it's hard to get both of them to be profitable at the same time.
Yeah, you have these, particularly in the long calendar spreads, you have these positions where you're long vega and then you're short gamma. It's a difficult and unwieldy beast to manage effectively. You want some boost to your vega, so you want typically a nice downside move in the underlying, but you need to keep it within the bounds of your gamma. You don't want to have the negative gamma overwhelm any gains you're making in the vega in that sense, where if you had a really, really sharp directional move, that negative gamma could easily outpace the long vol you have in the far month. So that becomes like you said, a bit of a balancing game between maybe setting where you have your hedges for your negative gamma, when you're talking about delta neutral and that type of trading. Keep those wide enough to give you a little bit of vacillation room so you don't wipe out any of your profits by continuously hedging your negative gamma, while at the same time allowing your long vol to pay for itself and to also collect a little bit, hopefully, of that decay to pay for the position as well. So yeah, it is definitely a tricky balance, and one that we see a lot of beginner and even intermediate and to a degree advanced traders struggling with on a regular basis. And typically the best way to manage those usually requires a lot of time and a lot of knowledge of the underlying and a lot of knowledge of the option space to be able to hedge those effectively.
Yes, that's exactly right, and it's very well put, because you do have to have a knowledge of how these underlyings move and what the effects of volatility on, and that business of yeah, go ahead and move. Don't move that much. We'll move a little bit, but okay, that's enough. That can drive you crazy, and that's the challenge of the calendar spread.
Yeah, all too often in options education, and we try to get away from this on the Options Insider, but even I think maybe we even have some of this to a degree because it's so endemic in the options education space, which is the focus on the expiration graph, and that's the extent of position management that a lot of new traders are taught. Here's the position you put it on, here's how it has maximum profit at expiration, here's the maximum loss, and that's about it. There's very little taught about the in-between stages, which is where the bulk of your money can be made or lost if you're not trading effectively. How to hedge your short gamma and manage that to collect the maximum decay while at the same time also allowing your long volatility position to work for you. And sometimes just looking at a raw expiration graph isn't too informative on how to best manage and handle a position.
Well, it's a very good point, and I think that the problem was born of the way information is disseminated. And you read books and you look at pictures, and it's simple enough to draw the expiration profile because everything is known once you reach expiration, and you basically wind up with intrinsic value or combination of intrinsic and theoretical for the calendar spread with non-simultaneous expirations, but trying to show position management is really kind of three-dimensional, and it's a lot more challenging because you not only have the expiration, but you have all the days one at a time leading up to it. And with each passage of the day, things are changing with the position, and then for each day you'd want to have a whole range of prices that the underlying could assume for that day, and then again all over again for the next one and the next one after that. So you're really trying to create like a three-dimensional matrix in order to understand the position management, and that can be unwieldy sometimes and not so easy to get a good handle on.
Nothing better than a good matrix. All right, Don. And of course, this is a pretty in-depth topic. I think you and I could both go on for a while. But if our listeners would like to learn more about position management and effective management of volatility within positions, of course, you can search the old Options Insider. We have a wealth of information on that. You can also go to volex.us and search for some position management information in there. I haven't checked. Who has volex.com? We should go shoot them an email and say, hey, you need to surrender it for the greater good.
Yeah, make no mistake about it. When we were setting up, looking for all the trademarks and the domain names, Bob did comprehensive searches, and I think this particular one was overseas somewhere. And person wanted an insane amount of
money for the squatters.
Site. So there's a lot of that going on of domain reservations and people just waiting for someone to come knocking on their door and offer a princely sum for having.
Exactly. That's why we are the Options Insider and not Options Insider, because at the time when we were setting up the site, the person who owned Options Insider was a squatter, and they wanted, like you said, an absurd amount of money. And I discovered if I could just put a the in front of it, I could save myself an inordinate amount of cash. And so we opted for the latter there and never looked back.
I think the same may be true about the Intercontinental Exchange, ICE, whose site is the ICE, because
yes.
I think ICE.com may have something to do with the diamond industry.
It does. The ICE.com is a diamond site, and they are a jewelry site, and I don't think they're going to surrender that anytime soon. All right, and with that, we're going to close out the old strategy session. And since you weren't on last week, Don, we have built up some feedback. Maybe we'll dive into the old mailbag here for the next section.
Very good.
Listener mail. Listeners write in.
Mail's in.
Mailbox.
All right, and welcome to the mailbag. This is where we read your listener mail, and then Don and I will make fun of you mercilessly. No, we answer your questions, and Don will even take your phone calls on occasion. He's quite the judicious fellow in that sense. So we're going to start it off with a question from Thomas. This came in our forum. The thread was entitled Potential New Segment for Vol Views. And Thomas writes, how about a segment that reviews OTC vol trading activity, since that is a big component of the current volatility trading landscape? Thanks and love the show. And Thomas, that's an idea I've been banding around for some time as well. I've been talking to Don a little bit about it and talking to our good old volatility pit reporter, Mark Sebastian, about that idea. And the problem with that is there are few reliable sources of OTC trading activity and trading data. I mean, by the very nature of OTC trading, it is opaque and non-transparent, and they don't exactly announce whenever they're putting up large vol swap or variance swap trades. So parsing that data and finding it and getting a good, reliable source of it that we could report on every week has proven difficult. We haven't given up the chase yet, but it's not exactly an easy thing to do, and I don't want to come on here and give numbers that are not exactly reputable. So we want to make sure if we find something that it is reliable and useful information for you. So the hunt is on. If anyone has any suggestions, by all means, send us an email at questions@theoptionsinsider.com, or send us a post on the forum, or send us a DM on Twitter, or go to volex.us, however you'd like to do it. But yeah, send us an idea if you have any for those, because we are in the process of looking for some good sources of OTC volatility activity. Next up in the old mailbag, we have a question in our forum again. This is from our user, goes by the handle Jersey Boy. His title is, "What do you think of listed versions of OTC vol products?" And he writes, "Not sure if you guys have discussed this before, but what do you think of the exchange's attempts to make listed versions of OTC vol products? I'm talking about the CBOE's variance products, as well as some upcoming swap products that are soon to be listed on the exchanges. Thanks for doing the show. It's about time someone did a show about volatility and volatility trading. Please keep it going. How about a daily vol views?" I can answer that last part first. Daily vol views, not on the cards right now. Maybe down the road.
Oh, there goes the landscape.
What do you say, Don? Every day, Monday through Friday? What do you say?
I respectfully decline.
There we go. But he also asks about the listed versions of OTC products, and of course, one of the more prominent ones are the CBOE's variance futures. This is the CBOE's attempt to capture some of that OTC volume, and if you're interested in that, of course, you can listen to our episode of Options Insider Radio. I believe it was number 80 we did a month or two ago, where I sat down with Jay Cowie, who runs the CFE, and essentially discussed those products with him, and they acknowledged that there are a number of problems with those products, and they had yet to attract any significant volume from the OTC world, and so they're looking to restructure those products to address that. I think the same is to be said for pretty much every OTC product that's been attempted to migrate to the exchange in some listed form or other. Probably largest example were the OTC credit default swaps that the exchanges tried to list in 2007. The CME, the Board of Trade at the time, as well as the CBOE, all listed various CDS products on their exchanges, and all received a rousing zero interest from any OTC firms. And it's precisely because what we've discussed on this show in the past about OTC volume. It is not transparent, and it is run by a handful of firms. I like to only have jokingly referred to them as the cabal, and they have this market all to themselves, and they're able to make spreads as wide as they want and do a lot of other things that you are allowed to do if you are one of the sole market makers in a product. So they have no interest in opening this product up to other sources of liquidity. In fact, they have a vested interest in keeping it very locked down to themselves and a handful of others, and so they actively resist any of these products whenever they're listed on the exchanges. And it's definitely an interesting challenge, and I know one you guys over at Volex are continuously working against with your realized vol products as well, Don, correct?
Yes, absolutely, because in many ways, using exactly the same formulas, for example, for a volatility swap that may be traded over the counter, we brought that to the vol contracts and to listed exchange traded products. And then, of course, the next challenge is penetrating those markets and trying to point out the benefits of transparency and having these contracts available in smaller sizes so that they are reachable to retail and to the average person, and not just the very large institutions that typically trade over-the-counter swap products such as vol swaps and variance swaps. But as you mentioned, it's a tough road to hoe because they are entrenched with these over-the-counter products, so making inroads sometimes takes a little while.
Yeah, I think a lot of hope emerged after the 08-09 debacle that a lot of the buy side, the actual customers who are using these products, would wake up to the dangers of the OTC world and start requesting and looking for listed versions of these products. I know the regulators have been trying to force a lot of things onto listed exchanges from the OTC world with mixed success as well. But yeah, there really hasn't been the outcry for listed products I think a lot of people were hoping for in the wake of the 08-09 meltdown. I think there's still, for whatever reason, the buy side still likes to execute in that opaque, non-transparent, high counterparty risk venue.
Old habits die hard, and when you get comfortable with something, even if someone builds a better mousetrap or offers an alternative, it takes a good deal of education. It takes a good deal of building the infrastructure, making sure you have the order flow, making sure you have the liquidity. Again, it's a slow process, but it's one that I think is going to turn in that direction, and we're going to try to help get it there.
And our last question also comes in from the forum. It's a silly one, but it's a fun one. I thought it would be fun to include on the show here. It's from our old friend, Complete Beginner. He's been around forever. I don't think he's a beginner anymore. Maybe he was when he started posting, but it's been a while. Hopefully he's a little more knowledgeable. But his question is entitled, "How about some blackjack tips?" And he writes, "I hear Don is quite the blackjack player. How about throwing some tips into the show? I know it's not really vol related, but it might be fun. Maybe a short segment at the end of the show." So, Complete Beginner, you have read my mind indeed. I have toyed with this idea and floated it to Don. And listeners, if you're not aware, Don has spent many a year in the seamy underbelly of the blackjack world. In fact, Kevin Spacey's character in the movie 21, that was based on your life, correct, Don?
Well, could have been close to it. But, we knew all of those guys.
But yeah, Don actually has been very active in the blackjack world for a number of years and is pretty well known on that front. So we thought it might be fun maybe if Don is willing and the guys over at Volex are willing and the audience is interested, maybe we'll throw in a quick, short 3 to 5 minute segment at the end of every show about some quick blackjack tips. Maybe we'll call it Splitting Aces to talk about the number one blackjack question I'm sure you get on a regular basis.
I'll tell you a very quick, funny story. Listeners may know that I do some volatility and options-related seminars for my former employer, Morgan Stanley, for their summer programs where they train the new hires, the analysts and associates who come in before beginning their careers there in the fall. And I do the derivatives training portion of it. And last year, I walked in, and before I opened my mouth to say word number one of the students or one of the participants raised his hand and said, "We Googled your name. Are you the Don Schlesinger from the blackjack world?" So I kind of smiled and I said, "Yep, guilty as charged." And he said, "You think you might do a segment or a seminar or a portion on that as well as on options?" I said, "Well, it may have to be for another time. We pretty close on our time schedule here, but maybe we'll schedule that somewhere else." So if listeners are inclined and if everyone agrees that it might be fun, maybe we'll toss in a couple of minutes at the end of shows.
There you go. Your reputation precedes you, sir. Yes, that might be fun. Maybe we will throw in every now and then a Splitting Aces segment. I like that title. I think it sounds appropriate for the topic.
Fair enough. That can be our first tip. Whenever you get a pair of aces, always split them.
There we go.
Calling each one 11 and starting out with 2 separate hands, then to keep them together and call it a 2 or a 12, which doesn't do you any good at all.
There you go, listeners. You got your first free tip right here. Always split your aces. All right, and with that, we're going to close out the old mailbag for this week and roll right into the Crystal Ball segment.
And now we take a look at the Crystal Ball.
Welcome to the Crystal Ball. Once again, this is where Don speculates wildly, and I have to restrain him talking about Eurovol. And, of course, Don, we also talk about the wide world of volatility on this show. So what are we expecting? What are we looking for? I know you mentioned some of the potential arbitrage opportunities we might be seeing in some of the Eurovol contracts. Is that what you guys are looking for this week?
Well, I'm going to keep an eye on it because it's interesting to me. Again, just to summarize very quickly, we have two contracts that'll be expiring in 9 days. And, of course, they have a current market price, and listeners can look at the two-sided markets that are being put up by our market makers and participants on the CME and the Euro FX. And in addition to those market prices, we already have the logged portion, the P-vol, as we call it, or partial realized volatility. And we have the stub, if you will, the part that's left to expiration. So when you take a look at the P-vol, they're both in the mid-10 range. But when you take a look at the market prices, they're somewhat higher than that, which means that participants are forecasting that the remaining volatility will be higher still, so that when it's averaged in with the already calculated volatility, you get to the price that traders are now trading the current June contract. So it'll be interesting to see whether those implicit forecasts or those inferred volatilities of more in the 1175 to 12 range actually pan out and turn out to be the remaining volatility, or if perhaps it's a little bit overstated and prices will come in a little bit.
It'll be fun to watch and see which way the customers and the traders start leaning in those products. And as they're gaining a little more liquidity and a little more traction, it's interesting to see the way the paper flow is developing out there in those products.
Yes.
All right, that's going to do it for our Crystal Ball segment, and that's also going to do it for this episode of Volatility Views. Of course, I want to thank my partner in crime here, good old Mr. Don Schlesinger, for joining me on the show this week. No week off for you this week, sir.
Well, I had a lot of fun. It's good to be back.
And before we go, is there anything new going on over at volex.us that you want to let our listeners know about? I know we've talked quite a bit in the past about your volatility cones tool, and we talked about it last week with Bob as well. Any updates on the volatility cones front that you want our listeners to know about?
We did an interesting study, and I'll finish up on this note. The volatility cones were described in previous episodes, and they sort of put certain bandwidths on likelihoods that realized volatility will either exceed or be lower than different percentile ranges. And Bob and I were kicking around a volatility cone for the past few years of the euro currency that's currently been trading. And Bob said, I'm going to go back about 5 years to about 2006, and let's take a look at quarter by quarter and see if we could see what some profitable trades would have been, supposing a theoretical value if there were such a thing as a vol contract, and how it would be trading, and take a look at 70 percentile, 90 percentile, 10 and 30, depending on whether we buy or whether we sell. And so Bob did a nice spreadsheet and took a look at the results, and he wrote to me and he said, gee, I'm a little bit disappointed because it seems that when I sell at the 70th percentile. Most of my trades are winners, and I get about 70%, 75%, just as it should be. And if I get a little fussier and I don't do as many trades in 90th percentile, he says, darned if they don't all turn out to be close to winners also. But when I do the same thing in reverse and I drop down to the 10th percentile, where volatility apparently should be very cheap, and I buy it every time it pops up, or I buy the 30th percentile, my results just don't seem to pan out, and they're not quite as good. And I said, oh, really? What a surprise.
That must have been a big, big shock to you.
But actually, I started to think about it for a while, and there really is a serious conclusion to be made here. The first was, we just didn't have a whole lot of data. If you do this for 5 years and 4 quarters and you use 20, possible periods and generate maybe a dozen trades or 15 trades. Some of them didn't generate any trades at all. You don't always have a 10th percentile or a 90th percentile. You just really don't have a lot of information. And as luck would have it, on the buy side, a lot of the trades that wound up losing simply were due to the fact that they were initiated during the year 2006, when apparently the volatility in euro was extremely low. So, the old caveat that past results do not guarantee future performance, you can resort to looking at Volcones as a tool, but they are history, and history does not always portend or foretell the future with a perfect crystal ball. As it turned out here, most buying of volatility during 2006 in the euro was destined to lose money, because it turned out for the whole year to be an extremely low volatility environment of about 6 or 7% or so. But I said to Bob, my conclusion would be that, look, sometimes we need to buy for one reason or another. That still doesn't mean that there isn't a usefulness for something like the volatility cone. It's not going to guarantee a winning trade all the time, but the fact that if you're going to buy, you'd still like to see what is the environment. If I'm going to shell out some money and buy something, I'd rather know that at that price, in the past, 90% of the time, the realized volatility that followed was higher than what I paid. Certainly would make me feel better than saying that 90% of the time it was lower. So you still can use these as a guidelines. They don't come with any guarantees, but it's still, in my opinion, an intelligent thing to do, and it can be a useful tool and a useful resource.
So you heard it here first from Don Schlesinger over at Volex, that you should always sell or not sell the Euro VolContracts. Never buy. It's a road to ruin.
Don't put words in my mouth.
All right. And that is going to do it for this episode. Of course, I want to thank all of our listeners for downloading and streaming and subscribing to this show. And if you'd like to send us some feedback and be included in our good old mailbag segment, then you can always post a question on the optionsinsider.com/forum. Just surf for or scroll on down to the Volatility Views forum and post your questions there. Don and I are always floating around in that forum, so you can hear back from us and maybe get your question read on the air. You can always also reach us on Twitter, twitter.com/options or twitter.com/Volex_info. Or you can shoot the guys at Volex an email directly at info@volex.us. Maybe you put Volatility Views in the subject line so they know you're writing about the show, and you'll get bumped to the head of the line, as it were. And that is going to do it. I want to thank all of our listeners for listening to the show. And, of course, we will see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.